Some trends are so influential they can move entire sectors of the market. Take demographics. Our aging population could impact the performance of all healthcare companies. But selecting precisely which companies will benefit can be challenging. The Healthcare Sector Spider ETF offers the diversification of the entire healthcare sector while minimizing your single stock exposure. The Healthcare Sector Spider, the next chapter in investing. Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for prospectus containing this information. Read it carefully.
You're listening to the Index Investing Show. This is America's only weekly program focused on the important stock and bond indexes and the financial products that track them.
And now presenting your host,
Ron DeLegge.
Coming up on today's program, how to reduce your taxes in retirement. They're going up. My program guest will be David McKnight, author of The Power of Zero. We'll be discussing that and much more. Also, happy end of quarter window dressing day. Yes, it's the end of another quarter. We begin to head into the inning of the year 2018. So want to explain what that is to you and how that impacts your bottom line. If you'd like to join us to talk a particular stock, mutual fund, or ETF, we can do that. 844-305-7800 is the number. Give us your first name along with your city. You can also follow us and tweet us live at Index Show. That's where you find me on Twitter. So, taking a look at financial markets, you know, it was Mae West, that beautiful actress who once quipped that too much of a good thing can be wonderful. And that's how investors have been feeling. That's how they've been feeling about 2018. Too much of a good thing has been wonderful. Since the start of the year, the entire U.S. equity market, as measured by the Schwab U.S. Broad Market ETF, that's ticker symbol SCHB, has effortlessly outperformed its global peers by a rather wide margin. Now, if we take a look at the actual performance, it's about 10.5% versus the total world stock ETF, which also includes not just U.S., but international developed markets and emerging markets, which is ahead by just a little over 4%. So both regionally and broadly, U.S. equity market is alone at the top. Well, what is behind the move? Well, international markets, particularly emerging markets, have been rocked by currency turmoil and trade tensions. This, in turn, has led to lower prices. Now, if you're a value investor and you're looking for value, you might want to look overseas. The MSCI EFA index trades at a 20% discount to its average forward price-to-earnings ratio based on data going all the way back to 1995. That's according to FactSet. And if that's not a steep enough discount to pique your interest, you bargain seekers, check out the MSCI Japan Index, which trades at more than a 40% discount to its 23-year average. So that's, by the way, ticker symbol EWJ follows that particular area, Japan. So there is some values out there in the global equity market. You just got to go find them. So the next question will be, what will occur with U.S. midterm elections? Will it disrupt the stock market's good thing? Or as May said, wonderful thing, right? Speaking, stocks have performed well, and I looked at this. This was my homework assignment this past week, doing research to find out, well, what has been the impact of U.S. midterm elections on the stock market? And I looked at this going back quite some time, and so let me report and give you an update what this potentially means for this particular U.S. midterm election. So historically speaking, stocks have performed quite well with a Republican president and a divided Congress, which is a good expectation of what might happen in November. Now, generally, the stock market prefers political gridlock because it removes the probability of policy extremes. Whatever unfolds in this year's midterms, history may once again turn out to be on the stock market side. Not only are we entering the most favorable part of the 4-year presidential cycle, but the S&P 500 has been higher 1 year after midterm elections than it was on midterm election day, every single time going all the way back to 1946. So those are the odds. The odds seem to favor a rise in stock prices. We've got not just the calendar that's working in our favor, but we also have history. It's doesn't always happen exactly like it happened in the past, but it often rhymes. So that's what's going on there. If you're just joining us, you're listening to the Index Investing Show. 844-305-7800 is the number if you'd like to join us. Talk about anything financial on your mind, investing, a particular stock, mutual fund, ETF, or investment strategy. We can do that. Coming up on today's program, David McKnight, author of The Power of Zero, will be on the show. You know, the U.S. government, if you didn't get the memo, has hundreds of trillions of dollars in unfunded promises for programs like Social Security and Medicare. And guess what? The only way that they can pay for those promises is to raise taxes. And unless the government slashes spending significantly, which they have not ever been able to do, we're heading for a financial disaster in which tax rates will need to double in order to keep the country solvent. So what does it mean for us as investors, us as retirement savers? Well, there's a massive freight train bearing down on the average American investor and retiree and person saving for retirement. And it's coming in the form of higher taxes. And so the question then becomes, if tax rates go up, how much of your hard-earned retirement savings will you really get to keep? And what can you do right now to shelter yourself from the coming storm? And so that's the whole point of McKnight's book, The Power of Zero, is how to get to the 0% tax bracket and transform your retirement. So that's coming up on today's show. Going to really look forward to catching up with Dave and talking with him about his latest book. 844-305-7800 is the number. We're here if you'd like to join us. I'd like to also wish everybody a happy end of quarter window dressing day. For those of you not familiar with it, window dressing happens when money managers reshuffle their investment portfolios by selling their losers and replacing them with stocks that have enjoyed a healthy run-up. What's wrong with that? Well, it's a cosmetic activity. It doesn't add any value. Window dressing. Really, when you think about it, the primary purpose of window dressing, it's not to help you or help the investors make money. It's really, the purpose is to make the money manager look good on paper. Wow. They held some of the, it makes them appear like they've held some of the best performing stocks during the quarter, when in fact, on window dressing day, or the days leading up to it, they may have actually sold their losers, bought those wonderful performing stocks after the run-up to make it appear like they were part of that party. And so window dressing is a nefarious activity. Again, it doesn't benefit investors. It increases trading cost. It's a cosmetic thing. It's like putting lipstick on a pig. At the end of the day, it's still a pig, right? The lipstick doesn't really do much to improve the pig's smell. It's a pig. It stinks. And so, in a similar sense, window dressing doesn't really improve a mutual fund's performance. If it stinks, it stinks. Cosmetically, it may look good on paper, but again, these are the sort of activities that you avoid when you make low-cost index ETFs the core or the foundation of your investment portfolio. There is no window dressing with an index fund or ETF because we're not trying to chase performance. So that's one of the things we want to help you understand. Well, coming up next, David McKnight, author of The Power of Zero. He'll be on the show. We'll be here, you be there, and I'll be back.
The Index Investing Show with Ron DeLegge.
You're listening to the Index Investing Show with Ron DeLegge. Go to indexshow.com to enroll in Ron's online classes for investors. Learn how to grow and protect your money.
All right, on my Twitter feed at Index Show, these are some of the things there that you can read and link to. I've got a retweet of USCF Investments, a nice interview there with John Love, the CEO. It's a video. He visited the New York Stock Exchange. He's been on the program a number of times. That's John Love, CEO at USCF Investments. They, of course, manage a number of commodity-focused ETPs, P standing for products like ticker symbol USCI, which is one of my favorites because it's a great core ETF as a holding and a position to commodities. It's got a broadly diversified approach. It holds many different commodity futures contracts, and I think an excellent barometer and proxy for commodities as an asset class. And that's what you want when you're investing for or building blocks for your core or foundational portion of your portfolio. You want broadly diversified funds that are proxies for the asset class that they're tracking. So USCI is a great core commodity ETP. If you don't have exposure to commodities, that's certainly one to look at. Also on the Twitter feed, Facebook says 50 million user accounts have been affected by a security breach. My comment on that, no bueno. Also, Tesla. Tesla has been in the news. They just announced a settlement. Elon Musk with the Securities Exchange Commission. Before that, of course, happened, my tweet was trial secured. Well, it seems like that's been replaced with settlement secured. So that's what's going on there with Tesla. Can't we just call it quits and merge the companies, Tesla and Tilray? Should it be called Tilresa or should it be called Telray? Please weigh in. Let me know what you think about that. Again, at Index Show. A nice chart from Charlie Bilello. He shows a chart of General Electric going all the way back to September of 2000. It was the largest company in the world with a market cap of $575 billion. Today, its market cap is now below $100 billion, a decline of more than 80%. My comment on that is this: investing in the safety of blue chips is not always safe. That's an unfolding train wreck, General Electric. And of course, there's others like them. Once upon a time, blue chips, companies that were stalwarts and leaders in their day. Sears is one of those companies that joins General Electric. Of course, I grew up in Chicago, and I remember, it was the Sears Tower for so many years. I still call it the Sears Tower. It's not the Willis Tower. Come on, get real. It's the Sears Tower. That's what it will always be. That's what it was. But the point is that you had a company like Sears that just got mismanaged. And it's amazing to me. Here is a company, I think in the 60s and the 70s. I grew up in the 70s and 80s, late 70s. But the point is that in Sears, at one time you had 1 out of 3 Americans had a Sears charge card. That was the store to go to back in the day. My mom, I would ask her, come on, can we go to Sears? But, of course, that obviously changed because the company never kept up. They mismanaged the enterprise. And this is a company, too, that began with catalogs in the 20s. And you think about, they had, a 40 or 50-year head start on Walmart? Walmart didn't start until the 60s. And yet, look what Walmart's done to Sears and to the whole retail industry. And, of course, what's happening to the business with Amazon.com coming along. So today's blue chips, as promising as they may look, may not necessarily be blue chips in the future. It's very difficult to project who they will be. That's why if you're going to play that game of trying to pick individual stocks, not against it, go ahead, play the game. But you just got to play the game right. And according to the rules that turn the odds of success into your favor. We talked a little bit about that on last week's program, that if you're going to make a gamble, if you're going to make a bet on an individual company or stock, well, do that in the context of your non-core investment portfolio. That's a much smaller portion of the overall investments that you own, where you can afford to take higher risk, where you can afford to lose capital, where you can afford to have higher volatility. That's the proper context for stock picking. If you're going to even do it, you don't have to do it, but if you want to do it inside your non-core investment portfolio. 844-305-7800 is the number. We're here every week at the same hour. This is the Index Investing Show. If you missed the program, you can pick up our podcast at iTunes. You can also find us on YouTube. Just search under the Index Investing Show with an emphasis on show, Index Investing Show. And then you can also find us at indexshow.com. So we are all over the place. I want to make a quick question to our audience. This is test your memories. And the correct answer, the person who tweets the correct answer or calls the show with the correct answer will get a copy of Dave McKnight's book, The Power of Zero. The question is this: what was the highest marginal tax bracket in the U.S.? What was the highest marginal tax bracket in the U.S.? So remember, income taxes began in the U.S. in 1913. So from 1913 to 2018, what was the highest marginal tax bracket? If you know the answer, 844-305-7800. And you can also tweet that answer at Index Show if you're on Twitter. Let us know what the highest marginal tax bracket was in the history of the country. And the correct answer will win you a copy of The Power of Zero, How to Get into the 0% Tax Bracket and Transform Your Retirement. So Dave McKnight, by the way, is warming up in the bullpen. He'll be joining us in the next segment. We'll be getting into all of his ideas about why your financial plan should change, why you should be rearranging your assets and your affairs to deal with this coming tax freight train. Taking a look at some of the other performers, we told you earlier that the U.S. Stock market has effortlessly outperformed the rest of the globe. Well, taking a look at some other major asset classes, commodities as a group, ticker symbol USCI, have been flat all year. They've not really done much. The global real estate market, ticker symbol REET, up about 1%, and the total U.S. bond market down 1.73%. BND is the ETF that tracks that area. And, of course, we've got this ongoing trend of higher interest rates. We didn't even talk about the Fed raising interest rates by another, 0.25%? So you've known about this, though, for months and months. We've been talking about this trend of higher interest rates. And from a tactical trading perspective, it's been a great trade for those of you that have been short long-term U.S. Treasuries. Ticker symbol TMV, which aims for triple daily opposite performance to long-term U.S. Treasuries. What a great trade. TMV is the ticker symbol. The ETF is called Direction Daily 20-plus year Treasury Bear 3X shares. What does that mean? Aims for triple daily performance to long-term U.S. Treasuries. TMV is the ticker symbol. It's up 19% since the beginning of the year. And, man, it's had a run just over the past month It's gone up over 10% over the past month alone. Dave McKnight coming up next, The Power of Zero.
The Index Investing Show with Ron DeLegge.
The investment world is full of complex and expensive products. At Sector Spiders, we recognize the need for lower costs, more clarity, and greater focus. So we wrote a new chapter for today's investors. Sector Spider ETFs divide the S&P 500 into 10 distinct sectors. You can see exactly what you're investing in with full transparency. Each sector has the diversification of a mutual fund, the flexibility to tailor your investment strategy, the all-day tradability of a stock, and the tracking of an index. Sector Spider ETFs can be used to customize your portfolio allocations, overweight or underweight your sector exposure, and minimize single stock risk. Now it's time to turn the page to a clearer, more focused approach. Sector Spider ETFs, the next chapter in investing. Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for a prospectus containing this information. Read it carefully. Visit us at sectorspiders.com.
Stop investing blindly. Listen to the Index Investing Show with Ron DeLegge every week on iTunes and IndexShow.com. Learn how to grow and protect your money.
We're delighted to have with us best-selling author David McKnight. His book, The Power of Zero, How to Get into the 0% Tax Bracket and Transform Your Retirement, is out. It's the top financial planning book at Amazon.com, and it's 5-star rated. David, welcome to the program. Great to have you with us.
Thanks for having me, Ron.
So your new book has been revised and updated with a new chapter on 2018 tax cuts. Yet it's common to hear people complain about how tax burdens are rising and getting worse. Help us, though, to understand what the latest tax rate changes mean for U.S. citizens.
Well, a lot of the media has focused on the impact that these tax cuts have had on Joe Main Street America. How many dollars is this paycheck going to increase? How many loaves of bread can he buy with those savings? But the real opportunity in this new tax code is to be had for people who are looking to reposition their highly taxable tax-deferred assets like 401ks and IRAs to tax-free investments like Roth IRAs and Roth conversions. That this really represents a historical opportunity. I mean, really, tax rates, you could make the case that the number associated with the tax bracket under George Bush from 2003 to 2013 was a little bit lower. But I'm telling you, the income parameters that define these new tax rates for the next 8 years have not been this good in 80 years. We're not likely to see these tax rates ever be this low again. And I like to tell people, I used to think that, sometime down the road in some distant, unknowable future, tax rates were likely to go up because of, and we'll get into why here in a second, but we didn't know exactly when that was going to happen. Well, we now know the year and the day when tax rates are likely, are going to go back up again. It's January 1st, 2026 by law. In order for that to happen, all Congress has to do is nothing. And frankly, Ron, Congress is pretty good at doing nothing. So what we have here is this historical window of opportunity within which to take advantage of historically low tax rates and getting dollars shifted to tax-free accounts. Those are the types of activities that we need to be taking advantage of during this period of low tax rates.
Best-selling author David McKnight is with us. Pick up his book, The Power of Zero. It's at Amazon.com. Now, one of the chief arguments your book makes throughout is that tax rates in the U.S. will be substantially and permanently higher in the future. Why do you believe that to be the case, and how should it change the way that we plan for retirement?
Well, it's interesting. I do workshops all across the country. Just this last week, I was in Dallas, and I can't even keep track of where I am, but, a couple different cities every week. And I asked rooms full of people, what do you think is going to happen to tax rates in the future? And to a person, nearly everyone raises their hand and they say they're going to go up. They're going to go up. And I say, how many of you guys have the lion's share of your assets in tax deferred investments like 401ks and IRAs. In other words, accounts where you haven't paid the tax yet, you're getting deductions at today's historically low tax rates, only to postpone the payment of those taxes till some point further down the road. I say, how many of you guys have most of your money in these 401ks and IRAs? And almost all the hands go up. So what I found is that there's this massive disconnect between what Americans think about the future of tax rates and what they're actually doing about it from a retirement savings perspective. So why do most Americans believe that tax rates are going to go up? Well, because they watch the news. They know there were $21 trillion of debt. They know that we have massive unfunded obligations on Social Security, Medicare, and Medicaid. They know that while the rest of the world is getting their fiscal house in order from a debt perspective, we're the only country in the world that is not taking advantage of this massive economic boom to get our own fiscal house in order, and we're just throwing stuff on the credit card. And as these 78 million baby boomers move out of the workforce and onto the rolls of entitlement programs, they stop putting money into these programs and they start taking money out. And so what that means is that there's going to be a day of reckoning. So what I've been doing over the last 6 months, we've actually been filming a movie that's based on the book, the documentary. And to do so, we actually interviewed most of the leading experts in the country on our nation's debt and our fiscal situation. We interviewed George Shultz, former Secretary of State, David Walker, former Comptroller General of the federal government, Larry Kotlikoff, PhD out of Boston University, one of the foremost experts on the debt. And basically what they're saying is, look, what the government is telling us is that we have a 106% debt to GDP ratio, which is not horrible in the big scheme of things. But what they'll also tell you is that they're not accounting for our debt in the same ways that every other country in the world does, and the same way that Nobel laureates, 20 Nobel laureates from the United States are actually telling us that we should be accounting for this. We have all these off the books liabilities, off the books promises that we have made to Americans that we can't get out of by law. And if you add up all of these unfunded obligations, promises that we've made that we can't afford to deliver on, we actually have a debt to GDP ratio of 1,000%. That means that we really have $200 trillion of debt, and the government has arranged to do our country's accounting such that we're not required to disclose that to the public. So we are marching into a future where it's looking very, very dicey. Tax rates will likely have to rise dramatically within the next 10 years, and that spells bad news for Americans that have the vast majority of their savings in tax-deferred vehicles like 401ks and IRAs.
David McKnight, author of Power of Zero, joining us. Pick up his book at Amazon.com. Skeptics may say, well, wait a minute, Dave, there's no such thing as a 0% tax bracket because the lowest bracket is 10%. Tell us more.
Yeah, I think that's a bit of semantics there. It's obviously possible to not pay tax because Mitt Romney famously said that 47% of America doesn't pay tax. They actually get tax refunds. So look, if you have so many deductions that your deductions offset whatever your income happens to be in a given year, guess what that means? That means that you're in the 0% tax bracket. There may not be a 0% tax bracket per se in the IRS's tax code, but if you're not paying any tax, you're not in the 10% tax bracket. And if you're not in the 10% tax bracket, where are you exactly? So the notion of the 0% tax bracket is simply a synonym for saying you are tax-free, you're not showing up on the IRS's radar, perhaps you're using your standard deduction to offset any distributions from your IRA or 401k, such that you're literally not paying any tax.
It's surprising how many individuals, even financial professionals, don't understand provisional income and its effect on a person's Social Security taxes. Talk about that.
Yeah, so provisional income, just to give you a sense, Ron, for how obscure this term is, I gave a talk to 100 CPAs a couple of years ago. I said, hey, how many of you guys have heard of provisional income? And only 2 hands went up, which is scary because what's provisional income? Well, that's the income the IRS tracks to determine if they're going to tax your Social Security. What counts as provisional income? Any 1099s coming out of your taxable bucket, so coming off your savings account, CDs, stocks, bonds, mutual funds, and any distributions at all from your tax-deferred bucket, which are your IRAs and 401ks, and 1/2 of your Social Security counts as provisional income. And the IRS adds all that provisional income up. And if it's a single person, it adds up to more than $34,000. Or if it's a married couple, it adds up to more than $44,000. Then up to 85% of your Social Security can become taxable to you at your highest marginal tax bracket. Now, I've done a lot of math over the years on a lot of different clients, and I basically found that, when you have, the average person that's paying 85% of their Social Security becomes taxable to them, that basically means that they've got a $5,000 to $6,000 hole in their Social Security because of a taxation that they weren't even anticipating. And how do most people go about plugging that hole? They take more money out of their IRAs and 401ks to plug that hole. So to compensate. So what we found is that if your Social Security gets taxed, you can run out of money 5 to 7 years faster than people who do not have their Social Security tax. So the remedy here, the antidote, is to try to get as much money into tax-free accounts like Roth IRAs, Roth 401ks, Roth conversions, some forms of life insurance, when structured properly, also qualify. If you can do that and have most of your income in retirement coming out of tax-free accounts that don't count as provisional income, you can actually keep your Social Security. You can have your Social Security tax-free, and that can literally extend the life of your investments from 5 to 7 years.
Well, you've written a great book, The Power of Zero, How to Get to the 0% Tax Bracket and Transform Your Retirement. David McKnight, thank you for taking the time to join us and share those great financial planning ideas with our audience. This is the Index Investing Show. I'm Ron DeLegge. Stay with us. More when we come back.
The Index Investing Show with Ron DeLegge.
Have an investing question for Ron? Call 844-305-7800 or send your questions to @IndexShow on Twitter.
By way of reminder, those of you that would like to learn more about the strategies that I teach on this program, how to build, grow, and protect your money, you can go to indexshow.com and enroll in my online classes. I've got our flagship course, which will teach you how to manage your portfolio with a group of low-cost index ETFs. I give you exactly what those ticker symbols are. And then I've also got some model ETF portfolios, depending on your level of risk tolerance as well as your age. Some model portfolios that you can use as guidelines and targets for your own portfolio. So I've got that. Just go to indexshow.com and link on to my online classes. It was Will Rogers that once said that the difference between death and taxes is that death doesn't get worse every time Congress meets. Great quote from Will Rogers. But one of the questions that I want you to understand and know the answer to is, what is the highest marginal tax bracket in U.S. history? What is that number? Does anybody know? If you do know the answer, call the program at 844-305-7800. Give us your first name along with your city and that number. The highest marginal tax bracket in U.S. history. You can also tweet the answer at Index Show on Twitter. And the person that answers that correctly will get a copy of that book, The Power of Zero, How to Get to the 0% Tax Bracket and Transform Your Retirement. So this is very important from a financial planning perspective, getting the right amounts of money in the right buckets. Of course, we've got an historical opportunity right now to take advantage of historically low tax rates relative to where they've been in the past. We know that they've been higher in the past. I mean, heck, in the 70s, the highest rate, or the average rate back then, highest marginal bracket was about 70%. Here we are today. What's the highest marginal rate? 37%. So the point is that taxes are substantially lower today than where they were in the past. So we know that they're going up in the future because the government can no longer, they don't have a choice, really, is what this boils down to. You can only kick the can for so long. And so instead of waiting around to see what happens and twiddling your thumbs and saying, well, you know, they may not raise taxes, or they might, or, well, we'll just wait and see what happens, you know. We'll just take a passive approach with this. No, you've got to take an aggressive approach to deliberately protect your assets from the threat and from the tyranny of higher taxes. And the way you do this is by shifting money into tax havens things like Roth IRA, Roth conversion. As McKnight mentioned in that interview, some forms of life insurance may qualify if they're properly structured. You can use them to mimic the same impact, or not impact, but effect that Roth IRA has. Roth 401k, Roth 403b. These are things that you should be looking at in your own financial plan and repositioning your money deliberately so as to pay the taxes now. No one likes to pay taxes, but if we do have to pay taxes, we'd rather pay them at today's historically low rates versus in the future when they are guaranteed to be much higher. And so this is what we want to help you understand. This is the whole point of prudent financial planning, because no one knows the exact number or the exact rate in the future. Nobody knows. We don't know the exact number. But what we do know is that it will be higher than what it is today, because it has to be. It's like one of those things like gravity, right? Things fall. We don't understand necessarily all the physics and science behind it, but we know that if you drop it from a tower in the sky, whatever that object is, it's going to fall. And so in a similar sense, we know that taxes are going to have to go up because you just can't afford to continue to spend money the way the U.S. government is spending money without to have some serious ramifications. And to pay for all that, you're either going to have to cut expenses dramatically, which they've never been able to do, or raise taxes dramatically, which they've done in the past and will likely do in the future. 844-305-7800. That is the number. At Index Show is my Twitter handle. Taking a look at what's going on in financial markets. These are some of the areas where it's paid to be an aggressive investor on the tactical side. Technology has been one of the top performing industry sectors this year. XLK is the ETF that tracks that area, ahead by 19% since the start of the year. XLY, consumer discretionary stocks, companies like Amazon.com ahead as a group by almost 20%. That is also a top performer. And then healthcare, ticker symbol XLV as in Victor, ahead by 16.5%. So right there, those are your top three industry sectors within the S&P 500 so far this year. And the ETFs that attempt to leverage that performance upward, ticker symbol TECL, that's the Direction Daily Tech Bull 3X shares. That's a top performing ETF. TECL ahead by almost 50% this year. Ticker symbol CURE, that's an easy one to remember. Cure, which tracks the healthcare sector with triple daily performance or leverage. Cure ahead by just over 43%, and that's another top performer. And then SPXL, which aims for triple daily leverage to the S&P 500, ahead by almost 23% since the start of the year. So why do I say this? Well, because of the fact that we want you to understand that if you're going to use leverage with ETFs, it's okay to do that within the context of your non-core investment portfolio. But the other thing is, the other rule for using leverage is that you want to do it in markets that are sharply trending in the same exact direction that you're trading in. And that is one of the fundamental rules that I teach about leveraged ETFs that you have to understand. If you follow those rules by keeping that within the context of your non-core portfolio and by only using leveraged ETFs with the triple, double, and triple with sharply trending markets in the same direction you're trending or you're trading in, you're going to stay out of a lot of trouble, and hopefully you're going to make some money. That's the most important thing. We want you to make profits. And so if you follow those rules, I think you're going to do fine. For you bears, because I know there's a number of skeptical investors out there, skeptical observers. I'm one of them. I'm skeptical about a lot of things. But, you bears have made some money if you've been trading China on the short side, if you've been bearish on Chinese stocks. Ticker symbol CHAD, that's been a great trade. CHAD aims for 100% daily opposite performance to China A shares. It's ahead by almost 16% since the beginning of the year. Those who say, well, bears haven't been making money, well, it's absolutely not true. Bears have been making money, but you have to be not a a random bear. You have to be a very, what we shall say, a very selective bear. You have to carefully choose the markets that you're bearish in. If you've done that in 2018, if you've been bearish emerging markets, if you've been bearish China, if you've been bearish long-term bonds, you've been doing pretty good. But again, you've had to be selective. So that's what's going on there globally in terms of sector performance. 844-305-7800 is the number. Just by way of reminder, you can pick up our podcast. It's available at indexshow.com. You can also find us on iTunes. Just search under the Index Investing Show. We're also simulcasting our programs at YouTube. Search under the Index Investing Show, and there you shall find us. You can also follow the program on Twitter and tweet us at Index Show. Seems like we don't have a correct answer yet for what is the highest marginal tax bracket in U.S. history. Who knows that number? What is that number? At Index Show, you can think about this. Tweet me at Index Show and let us know what that number is. You'll get a copy of Dave McKnight's book, The Power of Zero. Well, that does it for another episode. Join us next week. Until we meet again, may the market indexes be with you.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.